A giant milkshake of liquidity has been created by global central banks, with the dollar as its key ingredient. But if the dollar moves higher, this milkshake will be sucked into the US, creating a vicious spiral that could quickly destabilize financial markets.
The US dollar is the bedrock of the world's financial system. It greases the wheels of global commerce and exchange. The availability of dollars, the cost of dollars, and the level of the dollar itself each can have an outsized impact on economies and investment opportunities. But more important than the absolute level or availability of dollars is the rate of change in the level of the dollar. If the level of the dollar moves too quickly, and particularly if the level rises too fast, then problems start popping up all over the place. And that's why everyone should have a plan for a rapidly rising dollar. It doesn't need to be a base case, but it never hurts to be prepared. Today, however, many people are convinced that both the role of the dollar is diminishing and that the level of the dollar will only decline. People think that the US is printing so many dollars that the world will be awash with the greenback, causing the value of the dollar to fall. Now, it's true that the US is printing a lot of dollars, but other countries are also printing their own currencies in similar amounts. So in theory, it should even out in terms of value. But the hidden issue is the difference in demand. Remember, the global financial system is built on the US dollar, which means even if they don't want them, everybody still needs them. And if you need something, you don't really have much choice. And although many countries like China are trying to reduce their reliance on dollar transactions, this will be a very slow transition. In the meantime, the risks of a currency or sovereign debt crisis continue to rise. For now, countries like China and Japan need dollars to buy copper from Australia. So the Chinese and the Japanese want dollars, and Australia is getting paid in dollars. Europe and Asia currently do a very limited amount of non-dollar transactions for oil. So they still need dollars to buy oil from Saudi. And again, dollars get hoovered up on both sides. Asia and Europe need dollars to buy soybeans from Brazil. This pulls in yet more dollars. Everybody needs dollars for trade invoices, central bank currency reserves, and servicing massive cross-border dollar-denominated debts of governments and corporations outside of the USA. And the dollar-denominated debt is key. If they don't service their debts or walk away from their dollar debts, their funding costs rise, putting great financial pressure on their domestic economies. Not only that, it can lead to a credit contraction and a rapid tightening of dollar supply. And the US is happy with the reliance on the greenback. They own the settlement system which benefits the US banks, who process all the dollars and act as gatekeepers to the dollar system. They police and control the access to the system, which benefits the US military machine, where defense spending is in excess of any other country. So naturally, the US benefits from the massive volumes of dollar usage, and other countries have naturally been grumbling about being held hostage to the situation. But their choices are limited. What it does mean is that dollars need to be constantly sucked out of the USA because other countries all over the world need them to do business. And of course, the more people there are who need and want those dollars, the more is the pressure for the price of dollars to go up. In fact, global demand is so high that the supply of dollars is just not enough to keep up, even with the US continually printing money. And this is why we haven't seen consistently rising US inflation despite so many QE and stimulus programs since the global financial crisis in 2008. But the real risk comes when other economies start to slow down or when the US starts to grow relative to the other economies. If there is relatively less economic activity elsewhere in the world, then there are fewer dollars in global circulation for others to use in their daily business. And of course, if there are fewer in circulation, then the price goes up as people chase that dwindling source of dollars. Which is terrible for countries that are slowing down because just when they are suffering economically, they still need to pay for many goods in dollars and they still need to service their debts, which of course are often in dollars too. And so the vortex begins, or as we like to say, the dollar milkshake. As the level of the dollar rises, the rest of the world needs to print more and more of its own currency to then convert to dollars to pay for goods and to service its dollar debt. This means that the dollar just keeps on rising. In response, many countries will be forced to devalue their own currencies. So of course, the dollar rises again. And this puts a huge strain on the global system. To make matters worse, In this environment, the US looks like an attractive safe haven. So the US ends up sucking in the capital from the rest of the world. The dollar rises again. Pretty soon, you have a full-scale sovereign bond and currency crisis. We're now into that final napalm run that sees the dollar and dollar assets accelerate even higher. And this completely undermines global markets. Central banks try to prevent the disorderly move, but the global markets are bigger and the momentum unstoppable once it takes hold. And that is the risk that very few people see coming, but that everyone should have a hedge against. When the US sucks up the dollar milkshake, bad things are going to happen. Worst of all, there's no alternatives. What are you going to do? Yuan? The yen? The euro? Now, like it or not, we're stuck with the dollar, underpinning the global financial system. And that's why we all need to pay very special attention to the dollar milkshake theory.